All right. Well, hey, welcome to today's webinar. We do these monthly series, and we like to bring you some helpful topics about income analysis and other underwriting topics. So, my name is Mike Whitbeck, one of the co-founders of Blueprint. Been in the mortgage business 31 years, mainly as an underwriter. First 2 years, I was doing loan officer and processing. But we like to bring these webinars just to help out. All right, so this topic this month is business tax filing changes. We're doing underwriting. Obviously, we understand all the processes. Most of our webinars are focused on step four, income analysis. But that's why we like to show this. Now, we obviously have software for sale. Some of you guys are clients of ours that are on this call. Some of you are not. It doesn't matter. We're not here to sell anything. We just want to educate the community. This is our give back, right? We want to always help out the community as much as we can with some education to help out. All right, so why does this topic matter if you're in the mortgage business? Now, typically self-employed borrowers are already complex income analysis. Got a lot of great tools out there, including our Blueprint Income Expert that have made it easier over the years with our upload system. We review the documents for you and still calculate, but they're still kind of complex. And our software can't catch everything, right? There's some risk analysis that you just have to understand. Changing in tax filing type can also confuse the analysis of income. Now it becomes I got the math right, but can I do this or not do it? So what we're going to talk about today is how to recognize, evaluate, and solve these scenarios when borrowers do this. Now, let's talk about why somebody do it. Now, one of the things about being self-employed, as far as you think about like the real world thing and the underwriting world thing. One thing we often see people ask questions like, "Hey, my borrower is self-employed," and then you get the K1 or the 1120, and it says they own 2% of the business. In our world, they're not self-employed. In the IRS's world, they do have self-employment, right? So we have to kind of define what we're talking about there, and we'll go over that a little bit in the next couple slides. But when we look at borrowers that are qualified as self-employed, 25% or more, as all the guidelines say, once you're 25% or more, you are self-employed if that's where the income is coming from. You can have other forms of income. You got to think about the business more holistically now. As an employee, all you're trying to do is figure, do they work there? Do they qualify? It's not the person's job to make sure the business has good marketing, good finances, good investors, a good product. But when you become self-employed, that's all the things you have to start thinking about as an underwriter. Now, the business owner also has to think about why would I, the way I've got my business structured, is it efficient, legal, and in compliance? And you may need to change for a lot of these reasons. And that's why business owners may do this. Number one, it might be just due to company growth. They want to go from a sole proprietorship to an LLC or a C Corp. They want to take a better tax advantages from one structure to another, or they're looking to bring on a new investor, partner, or do a merger with another company, or the company split or sold. So this is the real world reasons why a business owner do that. So, quick story, Blueprint is an 1120S corporation. I'm 50% owner of Blueprint Solution. I have a partner who's the other 50%. We started off as a partnership because it was easier, cheaper, faster when we got started. We then switched from a partnership to a corporation for a lot of liability and insurance reasons, right? So we were always kind of started off as an LLC or a partnership. Then we switched to an LLC filing as an S Corp. So, the reason we did it was is it was more practical way to build a business. We started getting employees. We have payroll, so an S corp was a much better fit for us. So it could be as simple as that, or these other reasons. So I've experienced a tax structure change in 2015, I think it was, so almost 10 years now, and it was no big deal. The business didn't operate any different. And that's some of the things we're going to talk about now. So as a business owner, I had to consider these four things when I made the tax structure change with my partner. Now, the common filing types, just a quick recap if you're saying, boy, Mike, you're saying some things I'm just not familiar with. When we talk about, underwriting guidelines or, how to do things, if you look at like Fannie, Freddie, FHA, VA, USDA, whatever, you see things like Schedule C, 1065, 1120S, 1120. So this is when we're saying tax filing change types, it means what form you're using. Now, interchangeably, a Schedule C is mainly for sole proprietorships. 1065s are for partnerships. 1120Ss are S corps. 1120s are C corps. All right. So, but when you're in the guidelines, you're going to see the term of the tax form, not so much the name of the corporation or the type it is. And sometimes it says both, just so you know what I'm talking about when I'm referring to changing tax types. All right. The most common changes that you'll see from a practical standpoint are people start off with a sole proprietorship and switch to an LLC, a limited liability corporation. Now, many businesses start that way. I've got Mike's plumbing repair, right? I just go out, I pay 20 bucks and I file at my sole proprietorship. And then I'm out there and I realize, ooh, I'm a little bit exposed. If I blow up somebody's hot water heater while I'm out working, I could get sued. My business can get sued, and my house and my car and my 401k can get sued. I'm going to go file an LLC, a limited liability corporation, to give myself that protection from my business life and my personal life. For an underwriter, we don't really care. What they're basically doing is they have a Schedule C and they're sole proprietor, and they're changing to a Schedule C, which is meant also for single member LLCs, right? If you don't have more than two people, you can file with a single member LLC or an S corp. A little bit complicated, but just so you know, they have some options. Now, the other one that's common is you're an LLC and you go to an S corp. And what you'll see is they have a Schedule C form and they'll switch to an 1120S form. They're still an LLC. It's just how they're filing tax returns. Now, they do this they want to get the S corp election to reduce self-employment tax burdens, pass on dividends, and also change your tax structure. So you don't just get all like distributions, you get paychecks, 401k, taxes taken out of that, and your K1, things like that. But this is what you'll see when people switch over on the tax forms. Another common one is the LLC or 1120S into a full out C corporation. Now, in my 30 plus years of underwriting, I don't see this very often. Very few borrowers you run across actually run an 1120 corporation. There's a big difference between 1120S and 1120 C Corp, right? And the reason you do that is mainly you're seeking venture capital. In other words, you need money because all the other structures, you can't get stocks. Like any business you kind of think about out in the open, Ford, Amazon, Tesla, IBM, whatever, they're C Corps. You can buy stock and they can be listed. Unless you're a C Corp, you can't do that. No LLC can, no partnership can. They have limitations for that kind of thing. So that's typically why you see a C Corp do that, or they're doing a very high risk business like real estate or something like that, where they want that absolute firewall between their business operation and their personal, finances and things like that. So it's kind of a litigious thing. Hence why you got LLCs, limited liability corporations, and C Corps, which is really a full like basically a full get rid of the liability corporation. All right, now let's get back into our world and we'll get out of tax, CPA world. So what do we need to consider as an underwriter? So when we think about this topic, remember we got to go back to our core foundation as an underwriter, and that's stability of income, right? The guidelines don't care about a borrower's tax structure. Think about it. We don't really care what you pay in taxes. We go off of gross income. So if you have an employee and they make 100 grand a year, the qualification's off 100 grand a year. It's not off of the 70 they actually take home. So we don't care about any kind of tax structure, your employment tax structure, your rental tax structure, your business tax structure. Who cares? What we care about is stability. Stability is defined as, is the business operating the same? I changed tax structures, but did I change something else core fundamental? Did it change ownership? Or did whatever it changed, maybe they changed structures because they went from a C Corp or a 11, we'll call it a Schedule C to a full out corporation. Why do they do that? Did they do something that's, really different what they were doing before? And is that going to hurt their operating ability? Now, so we're going to go back to just one example in the guidelines. I'm just going to pick on Fannie Mae here. This is cut and pasted right from the guidelines. I didn't change a word in here. So when you think about what I just said, these kind of like overall arching thought processes as an underwriter, they come from the guidelines. And here I'm going to reference where I'm getting it from. It says in the self-employment section, the very first thing you got to do is any individual is 25% of greater ownership the business must be considered, right? Remember, we go from employee, do you work there, to business owner, do you got the marketing right, the financing right, the location right, the product right? There's a lot more to think about, and they outline it. The first thing to think about is the stability of the borrower's income. A change in filing type may affect that. The location, the nature of the borrower's business. Maybe you change filing types because something in that changed. The demand for product or service offered. Now, this one, I've trained underwriters for a long time, 20 plus years. This one, it asks the question like, Mike, do I have to be a Shark Tank investor to know if, Bobby's, hookah shop is going to go on for 20 years? No, the way you do that is the business have stable sales, stable revenue, stable expenses, right? I wouldn't know. The Shark Tank guys, are making a good educated guess. But as underwriters, we're not supposed to know the market. Oh, the next hot trend is, electric vehicles. Are those going to last? Not that we'd ever really finance somebody that owns an electric vehicle corporation. They're typically very well dispersed. But you understand what I'm saying is not really our job to evaluate product if like product market fit. The way we evaluate that step is the business generating consistent revenue and it looks like it's, stable currently. Now we got financial strength and the ability for the business to continue generating and distributing sufficient income. That is the key point. Again, it's stability and the ability for the business to keep generating. Now back to like kind of putting everything together I just said into one more cohesive thought. All right, I'm an underwriter. I get a situation where a hardware changed from a Schedule C, a single member LLC, to an 1120S. Now I got to sit back and consider the following. What if the hardware store operates the exact same except for the tax form? Does that really, change anything in my thought as an underwriter about the business? Probably not. I would say in almost every case, not. What if the hardware store changed from a hardware store to a gas station? They had the same building, but they decided, you know what, hardware sucks. I want to do gas and chips and pop and hot dogs instead of, selling nails and hammers, things like that. Well, it's the same business. Maybe they switch tax forms, or, even if they didn't switch tax forms, if I see that in a Schedule C or 1120S, uh, I don't know. Do you know what you're doing as a gas station? Because remember, one of the core things about self-employment is 2 years minimum history. And you can only go down to 1 year if you meet the exceptions for they have prior history of doing that type of thing or whatever. So if a business changes professions from a hardware store to a gas station, tax form or no tax form, that's a problem, right? You don't know if they're any good at running a gas station yet. They don't have enough history. Now, what if the hardware store is still a hardware store, but they bring on a 20% investor? All right. Well, the hardware store might not be affected, but my income as the owner of the hardware store might be affected. What if the hardware store changed from a Schedule C or partnership to a corporation because they went from 1 to 5 locations and I have a 75% increase in income? Can I use that 75% increase in income? That's a big change. Maybe they opened up and they're doing really well because of the new guys in town, but next year they fall apart. So this is kind of, they change tax filing types, or even if they didn't, right? I've got to consider that kind of thing. But what if the hardware store just changed names? Like those True Values, right? I'm sure they're all over the country, like they are here in Michigan. Like there's one here in my hometown. It's called Pete's True Value or Peter's True Value. If it changes to Bob's True Value, do I care? No. But if Bob's the new owner of that location, I might care, as far as an underwriter goes, right? So that's the practical implications for an underwriter. We're not CPAs or taxes or looking for, Shark Tank investment. Hey, are you going to be okay doing this or not? We're just trying to look for stability. Now, there's a special note. A lot of underwriters, I don't know if Ed's seen this, but Freddie Mac, I believe it was 2024. I could be wrong, could be early 2025. I should have looked up the guideline change. They actually put a rule in to clarify. And I think the reason they did this was happening and underwriters were not thinking about like the previous examples here. What if a hardware store changes their ownership, right? Maybe I go 50-50 with somebody now because I don't like being a solopreneur. Like I need the expertise of somebody else, or I need an investor to grow my business because I don't have capital or expertise or something like that. Well, Freddie Mac put in writing, and I don't believe any of the other ones say, and the reason I say I don't believe, I've looked at the guidelines, obviously I don't see it anywhere, But Freddie put a change in there, said, hey, if you change from a sole proprietorship, to an S corp or something like that, so a Schedule C to any other tax filing, and the borrower's ownership interest change, you've got a problem. These are now considered separate independent businesses. Now, what does that do to your underwriting? Well, I got my Schedule C in 2023 and I've got my 1120S in 2024. These are not the same businesses now. So now I've got to say, does this person qualify for the 1 year exception? Now, for Freddie Mac, I probably wouldn't do it. And because what's happened is they went from earning all the money to half the money. So even though the business may be the same, it's still, 500 grand in revenue and $250,000 in costs and a net profit of 250. This person is now splitting the 250 between two people in some kind of structure. So now my stability of borrower income has changed. And if I'm going to go back a couple slides, what do they care about in Freddie or Fannie Mae right here? The stability of the borrower's income is a different statement than the ability of the business to keep generating and distributing sufficient income, right? It's probably the same, but your income may have been affected. So again, you got to think about this stuff holistically and is it going to affect your underwrite? Now, Freddie is putting in writing, you can no longer do this. Like we're putting a line in the sand here where we've got to let let this happen. So what would happen if I had this borrower at Freddie Mac? I would have to wait another year to qualify this borrower. Or, if I really want to kind of risk that this didn't change, I could go to Fannie Mae or one of the, FHA, VA, USDA, probably Fannie Mae more than likely. So, so that's what we're talking about in general. We have an income calculator called Income Expert. If you're using spreadsheets, which I hope you're not, I hope you're using something more sophisticated or any kind of other digital kind of meaning. What I'm trying to show you is this exact example that I just went through. So in our software, what we tell people to do is I've got the same business, right? It didn't change. So we'll go the first example. All I did was change my tax filing type. It's not a change of business names. There's no ownership change or anything like that. So I put everything in my Schedule C for 23. I don't have anything for 24 because obviously the business changed. And I can see that based on the way I analyze the Schedule C, that the income is 156,700 or about 13 grand a month. Of course, I filled out my 1088 form, right? Gross sales are 500. I got a little bit of returns allowances. My gross revenue is 499. My total expenses are, 25 grand, and I got $150,000 profit, right? So basically I'm making about 50% of what I bring in. So I got that all filled out. Okay, so that's my benchmark. Now, when I switch to the 1120S, of course, I don't have anything right now in the old year because I just switched, right? And I need to analyze it. So now I got to look at it and go, all right, I need to, look at this entirely. But look how my business structure has changed the way the borrower is paid. Now, instead of making, what do we say here, about 156 a year, which is about 13 grand a month, I'm over here, and this borrower now has made about 173. Well, good, it went up about 20%. That's awesome. But I get some of my pay now through W-2. I get some of it through K-1, and I still get my business adjustments because I'm still 100% owner of the company. That didn't change. So this is a qualified change. Fannie would accept this, Freddie accepts it, FHA, VA, USDA accept it. But how come I have no income analysis down here? Well, I have to now basically get the number, and this is the way our software works, however you want to do it. I got to get this number, 156,700, and bring it over to this. Now, I don't know in this webinar you're going to see it because we do also record this and put it on replay. So you might see it, 6 months after I do it. We're actually creating a linking feature where you can be able to link these income together if they qualify. Right now it's manual still, but we're fixing that. So I'm going to go ahead and stick all the pay into the W-2. So in the schedule or in this one, 56,700, I'm putting it under W-2 only because W-2, there's no mathematical change to this. Like this all gets counted. If I put in a K-1, I'd have to do a distribution check and all that, which Schedule Cs don't do distribution checks. So this is a technicality, but the concept is I've got 156,700 in the previous year. So now when I hit save calculate, I've got a 2 year analysis and I can see that my 2 year analysis is 72, 29, 17, right? So I've got the income, I've got the, oops, let me put 100% ownership. Help if I put the ownership in there. Sorry about that. There we go. 13,758.33. I'm going to edit this video, fix my little error there. But the bottom line is I'm comparing 156 from last year to 173. Now let's do a few of those scenarios I just showed you in here. What if the business was 50% now, right? So there's my 75K. Now remember, the 50% change in ownership doesn't affect my profit last year because I was 100% owner. But what if now I'm only 50% owner? So let's just do a very practical change there. This could be possible. When I hit save calculate, well, now the income dipped down quite a bit, right? So now it went down and I'm at 166, right? So there's a bit of a change because my cash flow adjustments changed. But more than likely this would drop down a little bit too, or that or the business is doing much better. But this would also be stable. So if I split my ownership but my overall income didn't change very much. Yeah, like now I'm not the full owner, but guess what? I made 166 with my portion of the business, and I made 156 last year when I owned all of it. That's no big deal. Now, Freddie Mac would not see it that way, but everybody else will see it this way. But in real life, let's just say I split the business. The comparable income is still about the same. I've got 500 grand in revenue there, but my K1 dropped down because, obviously I'm not going to make as much money as I did before. And it dropped down to 50,000 because of that split. Save calculate. Well, now I've got a 15% drop. So in this case, the Schedule C was higher. And when I split the business, I got W-2 and I still got my K1, but it's not as high now as it was last year. And it dropped down, 16%, which isn't horrible. You may want to prove that as an underwriter, but our software has a 10% threshold until an underwriter can review it. That's just the way the software is set up. But but that's all really I would just want to kind of show you guys. So going back to the slides, reiterating a couple points. Let me go. All right, so we got to go back and remember the couple of key points here, right? Stability, stability, stability. That's if you remember any slide in here, this is what we're trying to do. We don't care about tax structure, we care about stability. Is about the business operating the same? Is there a change of ownership that would have affected my stability? And does this change, you know, allow me to keep operating? Now, I talked about that, what if you have five locations now and it goes way up? That might be temporary. It might go down. Even though it's upwards, just because upwards doesn't mean automatically approved, that kind of thing. So, all right. Well, that's what I got for you today.